Hi, I'm Jeff Turnahoy, head of America's research at Lipper, and today I'm joined by Greg Kolb, portfolio manager of the Perkins Global Value Fund. Thanks for joining me, Greg.
Thank you.
Greg, let's talk about the strategy of your fund. What sets it apart from its peers?
So we take a defensive approach to compounding returns in the long run. We believe that mitigating losses when turbulence strikes is a key element to compounding higher returns over time, but with less risk along the way. And so for us, when we look at stocks, it's about downside risk before upside potential. That's the right order in which to consider those two elements of the investing equation. And it's also about building widely diversified portfolios as another way to control the risks that we're taking. And so by being opportunistic, but also being defensive and careful with our stock selection and overall portfolio construction, that's how we compound returns over time.
Your fund's been recognized by Lipper for having the best risk-adjusted returns over the past 5 years among its peers. What are some of the factors you would attribute your success to?
Well, at Perkins, it starts with our team. We have a group of people who have been together for a long time, and we all have one consistent approach to how we invest in equities. And so everyone is very well trained in that. They're very good at executing it on a day-to-day basis. And so from that, we have another number of characteristics that I think differentiate us. One is a calm temperament. We don't let the headlines get us too excited on the day-to-day, blow-by-blow of the stock market. We have a long-term focus. Full cycle returns are the objective for us. It's not about how we did yesterday or last week, which is what you see more and more on Wall Street. And over time, we have also spent a lot of time worrying about what can go wrong. Wall Street is a very bullish place, and excessive bullishness can get you into trouble as an investor. And so we spend a lot of time thinking about the negative possibilities. And those are all things that, while they're straightforward in their nature, not a lot of people actually execute that on a day in and day out basis. And so the team has done a great job in that regard.
I was hoping you could expand on a couple of notions you brought up earlier, low volatility, mitigating risk. How do those factors work at Perkins?
So for us, the process, you can see it at two levels: the type of stocks we buy and then the way we construct the portfolio. So the type of stocks we buy, from an idea generation standpoint, they're out of favor. So the stock is going down or the multiple has compressed. The news is typically negative. That gives us reason to believe that further downside is limited. We also emphasize the quality fundamental characteristics. So we want companies that have strong financial positions, competitive positions which can endure the test of time. Those are also elements that help us reduce the risk once we buy a stock. And then at the portfolio level, it is about having a wide range of cash flow drivers at the companies we own, a wide range of book value drivers at the companies we own, so that we don't have too much exposure to any one thing. You can make mistakes, you can have the better end of the trade, but it goes against you. That's the nature of buying stocks. And so having a diversified portfolio helps make us in a stronger position.
Okay, so as a value manager, do you find yourself attracted to those stocks that are perhaps out of favor by other managers?
Yes, and it's not just a casual attraction. We actively target which parts of the market are undergoing excessive selling. One of the most basic principles of investing is you want to be buying from people who are selling, hopefully for emotional reasons, as opposed to cool, calm analysis. And because that gives you the better likelihood that you're getting a good bargain when you're purchasing a stock. And so an example for us over the last few years has been in Japan, where that market has been in a bear market for 20 years. Not a lot of people are or have been very optimistic about the prospects. Valuations are very cheap. Hope has been sort of crushed out of the market. And when we go in, we do our bottom-up work, stock by stock. We have found a number of smaller and mid-cap sorts of companies that meet these criteria I mentioned of out of favor but have good defensive characteristics. And we've done well. We've made money over time, and that's a good testament to the benefits and the power of targeting going against the crowd in selected, careful ways.
Okay. Thanks for joining me today, Greg.
Great, thank you.
On behalf of Perkins Investment Management and Lipper, I'm Jeff Turnahoy. Thanks for watching.